Hey, what's up, my friend? So, in today's video, you'll discover how to trade with a small Forex trading account. Okay? And we are going to do it right without blowing up your trading account, without taking huge risk. And if you follow the tips that I'm about to share with you, you can even, take this small trading account of yours and grow it to six figures and beyond. Sounds good, right? Then here's what I want you to do right now. Hit the thumbs up button below, right? And subscribe to my YouTube channel, right? The button is all below. Just click on it. And this way, whenever I publish a new training, you'll always stay up to date, right? So do it right now, right? Just hit the thumbs up button and subscribe to my YouTube channel. The button is below. Just click it. So with that said, right, let's begin. So the first tip that I want to share with you is that you must find the right broker when you are trading with a small Forex account. Okay? What do I mean by finding the right broker? This means is that you must find a broker that lets you trade micro lots or even nano lots. So let me explain. So what is a micro lot, right? So a standard lot, is 100,000 units. Okay, a mini lot is 10,000 units, and a micro lot it's 1,000 units. So you want to find a broker that allows you to trade 1,000 units and below, right? This way it allows you to better manage your risk, which I'll give you an example later on. Okay, not all brokers let you trade 1,000 units or less. So chances are, if you want to find a broker that lets you trade 1,000 units or less, you must find a broker that adopts a market maker business model, right? If the broker adopts a market maker business model, then you can trade such size. And again, some of you might be thinking, but Rayner, market maker, they hunt my stop loss, blah, blah, blah. No, it's not true, right? I've done a video, some time back. You can check it out and explain why that is just simply their business model, and they don't have the incentive to hunt your stop loss, right? Because if they do, they'll be out of business pretty soon. So first thing is you must find the right broker that offers you to trade micro lots. Okay, and let me explain why. So let's say, for example, you have a small trading account, right? Let's say it's a $500 trading account. Okay, and if you were to go with a broker, right, some brokers offer a minimum of one mini lot. So if one mini lot is 10,000 units, and one pip, right, it's $1. Okay, for one mini lot. Okay, let me just put it a mini lot. Okay, so this means is that if you want to adopt risk management on this $500 trading account, let's say you're going to risk a 1% risk on this $500 trading account. So a 1% risk on a $500 means is that each trade you should not lose more than $5 if the trade hits your stop loss. So your risk, right, let's say it's not more than $5. Okay, so now you know that on a mini lot, one pip is $1, and your maximum risk on each trade is only $5. So what can you conclude? Well, you can conclude that the maximum size of your stop loss on that trade can only be 5 pips. Can you see that? 5 measly pips. And probably you're going to get stopped out of the trade, right? Because your stop loss is way too tight. And that is the problem with trading, right? Brokers that offer a minimum of one mini lot is that, your stop loss is too tight and your trade doesn't have room to breathe. Now, on the other hand, let's say you go with a broker that offers you micro lot. What's the difference, right? Let me just redo this. So let's say a broker that now offers you micro lot. So a micro lot, right? One pip is now 10 cents. Okay, 10 cents. And let's say again your risk, right, per trade is $5. So what this means is that now when you trade a micro lot, right, you can have a stop loss of up to 50 pips and still risk this $5 risk per trade. But your stop loss now, you can see it's wider. You have 50 pips of buffer to trade with, to have as your stop loss. So this is the difference, right, between trading with a broker that offers a minimum of 0.1 lot and trading with a broker that offers, right, a minimum of 1 micro lot. Is that the size of your stop loss, right, can be wider, right, if you are trading with micro lots. And this is important, right, because right, you want to adopt proper risk management. Doesn't matter whether you're trading a $500 account or a $50,000 trading account. Your risk management is paramount. It's important, right? Because on a small account, if you don't apply proper risk management, right, those habits, right, will be brought forth when you're trading a larger account. And when you are not adopting proper risk management on a small account, chances are you'll not adopt proper risk management on a large account. And that's when, things go really wrong on a larger scale. Okay, so the first tip that I have for you is, go and find the right broker that offers you to trade micro lots, right? This is important because if you want to, trade a small account, you must be trading smaller size. And not all brokers allow you to trade smaller size. So usually brokers who adopt a market maker business model, they allow you to trade micro lots and below. The second tip that I have for you is that you want to add funds regularly to your trading account, especially when your trading results are already consistent, right? Don't have the mindset that I'm going to take a small few hundred or few $1,000s trading account and run it up to a few millions in a matter of few years. Trust me, it's not going to happen, right? For every one of those success story that you hear, there's another 99.99% of failure rate that you don't hear, right? This is why news media, they like to sensationalize all these headlines to sucker in new people, new traders to come in and try and lose their money along the way. Okay, so that it does happen, okay, from time to time, but the failure rate is much, much higher, and this is something that you don't see. Okay, so bear this in mind. Okay, don't try to have the goal or even the wish or the hope of taking that small account and ramp it up to 6 or 7 figures. Just like that, okay? So let me explain why. Let's say, for example, again, you have a $500 trading account. And let's say you grow it for 20 years, right, over here, with let's say a return of 20% each year. At the end of 20 years, that is about $19,000. If you ask me, that's not really a lot, right? After 20 years, I think if you work full-time, you can probably make more than $19,000 after 20 years. Okay? So now, what if we, start to add funds regularly to our trading account? Maybe you have a full-time job and every month, right, you put in extra money into your trading account. Okay? So in this case, right, every month you save about $200 and each year you can put in an additional $2,400. So again, you're trading with the same $500, but you're putting in $2,400 to your account every year. 20 years to grow with a return of 20% a year. How much would that be? More than $500,000 just by saving the additional $200 a month and funding it to your trading account. So can you see the huge difference, right, between not adding funds to your account and adding funds to your account? The difference it's a lot, right? So this is how you grow your account to 6 figures and beyond, right? If you have a small account, it's not the end of the world. If you have proper risk management, you add your funds regularly, right? You trade with an edge, you can still grow that small account, right, into something substantial. So this is the second tip that I have for you, right? Add funds regularly to your trading account. And you want to do this, right, when your results, right, are already, getting some consistency. Not when, you're still losing consistently and you add more, funds. It's like adding more fuel to the fire. It's going to, bam, boom, right? So a little bit of common sense down here. Now, the third tip that I have for you is think in terms of R, right, and not the dollar sign. So I understand, right, when let's say you're trading $500, right, and at the end of the year you only make $100 out of that $500 account, and it looks pathetic, right? Like, Rayner, I spent so much time, effort learning how to trade, and I only make a measly $100. I know how you feel, right? And this is why I said think in terms of R and not the dollar amount that you make, right? So what is R? So I'll explain. So R is basically, right, the return you make, right, relative to the risk that you've taken. So let's say, for example, you risk $10 on a trade, okay, and you make $100. So in return, right, what you take is that your total gain divided by your your risk per trade. So it's a gain of 10R, or otherwise known as a 1 to 10 risk to reward ratio. All right, so this is how you calculate your R multiple. So similarly, right, if you, let's say you risk a $10,000 on a trade and you only make $1,000 on that trade, what is your R multiple? Again, take the gain divided by your initial risk. You'll realize that your gain is only 0.1 R. So between these two trades, right, which is a better trader? Well, if you ask me, the trader who achieved a 10R gain on the trade, right, definitely have a better performance than a trader who just made 0.1 R. Even though he made more money, but in terms of objective performance, that trader who achieved 10R is a better trader, if you ask me. Okay, so this is what I mean by, think in terms of R. So when you start to, think in terms of R, this is where you can get objective in your trading. Because let's say, for example, you have a $500 trading account, and let's say you do 20R on that account, risking 1%. So what this means is that 1% of $500 is $5, right? 20R, right? So you multiply by 20, you make a gain of $100, right? Didn't seem much, but this is a gain of 20R, okay? So imagine this, right? As your account grow, maybe now this is a $500 trading account. Maybe in future you're trading a $500,000 trading account. So when you are trading a $500,000 trading account, okay, a $500,000 trading account, 1% risk of 500K is 5,000. And again, you make that same 20R on that account, right? Maybe that's the average you do per year. What is the outcome for this, right? This is clearly a gain of $100,000. Can you see how your R multiple is the same? Your percentage risk is the same, but because of the size of the account that you're trading, now the outcome is vastly different, right? You're making so much more money, even though, pretty much everything else is the same. Same strategy, same entry, same exit, same trade management, same trading plan. Only difference is the size of your account that you're trading. Okay? So this is why I say, think in terms of R, right? Even though I know your account is small, don't think about, how many dollars or how many cents you're making. Think in terms of how many R I'm making on average per month, per year. That's a more objective way to, gauge your trading performance. Because as you mature as a trader, as you add more funds, as you trade with a larger account, that R multiple, right, your average R multiple will stay with you, right? I mean, if you're trading the same system. But what will change is the amount of money you're trading and the amount of money you're making. Okay, so this is what I mean by, think in terms of R and not the specific dollars or cents. And the final tip that I want to share with you is that when you're trading a small account, right, this probably means you are maybe new to trading, you're trying a new trading system, you're trying a new strategy or whatever, right? You want to learn and profit from your mistakes, because when you're trading a small account, that's when the mistakes are not so costly. Because after all, even if you do blow up that account, it's what? $500. Compared to trading a $500,000 account and blowing up that money, that hurts a lot more. So when you're trying out something new, when you're new to trading, right, make all the mistakes you want, right? You're going to be as bad as you are when you get started in trading. Learn from the mistakes, profit from it, right? And those are the same mistakes, right, that you can avoid making, right, when you are trading a larger account. So, make all the mistakes you want and learn from it. But the question now is, you might be thinking, okay, Rayner, how do I learn or profit from it, right? So let me share with you 3 questions, right, that you can ask yourself, right, to learn and profit from your mistakes. Number 1, what's your mistake? So maybe you are trading a small account, and the first mistake is that, instead of clicking buy, you click sell. So what's the mistake is that you messed up your order, right? You didn't know that you are clicking the sell button instead of the buy button, or you're clicking the buy button instead of the sell button, right? So what's your mistake, right? Is maybe you pressed the wrong order. Second question is, why do you make it? Maybe it's because you're new to the platform, right? You are, very new to this platform. You don't know how to use it, so that's why you make that mistake. Third question, how will you prevent it? Well, quite simple, right? If you want to prevent yourself from making such silly mistakes, right, open up a demo account, get familiar with the functions, right, the buy and sell button, so you don't, get confused between the different orders, right? So that's how you can actually learn and profit from your mistakes, right? So this 3-step question, right, will help you, right, with it, right? Another example, let's say you make another mistake of maybe, let's say, position size. Instead of risking 1% on the trade, you risk 10%. Okay, that's your mistake. Why did you make it? Or maybe because you're doing some manual calculation and your math isn't too good, or it's a careless mistake on your part. Okay, that's why you made a mistake. How will you prevent it? Maybe you do some Google search and you realize, hey, there are position sizing calculators that is available for free, and it's better to use them instead of trusting your own mathematical skill. All right, so that is how you can actually prevent making those mistakes in future. Okay, so this is the 3 questions that you can use to profit from your trading mistakes. Right. So with that said, let's do a quick recap, right, to what you've learned today. Number 1, if you want to trade with a small Forex trading account, you must have a broker that offers you to trade micro lots. Okay, these brokers, typically they're not ECN, they are usually market maker. That is their business model. Perfectly fine, right? So don't have anything against it. You can read some of my articles. I've written on it before, right? And really, that's the way they make money, their business model. Number 2, you want to add funds regularly to your trading account. As mentioned, right? If you're just going to trade that small account and you're going to compound it over time, over the long run, yes, you can make money, right? But it's nowhere near, right, compared to another trader who regularly add funds to the trading account. You saw the difference, $19,000 versus $500,000. That's a huge difference just by, saving additional $200 a month. Okay, so add funds regularly if you want to, scale up to 6 figures or even 7 figures. Third thing, think in terms of R, not the dollar amount, right? I know it's sucky, right? $500, you make $50. It's like, what? $50 only after so much time, effort, and learning, right? Again, think in terms of R. How much you have made relative to the risk you've taken, right? That is a more objective measure. And also, as shared with you earlier, once you know what is your average R multiple gain per year, you can sort of project how much you can potentially make, right, on a larger account. And finally, right, profit and learn from your mistakes. I shared with you the 3 questions, right, on how to do so. Number 1, what is the mistake that you made? Number 2, why did you make that mistake? And number 3, what is the one thing that you can do right now that prevent you from making that mistake again? Okay, so very powerful 3 questions, right, to actually learn and profit from your mistakes. And there are the 4 tips, right, that I want to share with you on how to go about growing a small Forex trading account. Okay, so with that said, I've come towards the end of this video. If you want to learn more about my own trading methodologies, strategies, and techniques, what you can do is go down to my website over here, tradingwithrayner.com. Okay, tradingwithrayner.com. Just scroll down and you can see a couple of trading guides over here. It really depends on what you want to learn, right? Maybe you want to learn price action trading, right? Learn how to better time your entries, exits, market structure, support resistance, and stuff like that. Just click this orange button and I'll send it to your email address for free. On the other hand, if you want to learn more about trend following, how do you write massive trends in the market, right? Then this ultimate trend following guide is for you. Just click this orange button and I'll send it to your email address again for free. Sounds good, right? So do it right now. And any questions, feedback, let me know in the comment section below and I'll be glad to help. And if you've enjoyed this video, hit the thumbs up button, subscribe to my YouTube channel. And with that said, I wish you good luck and good trading. Until next time.